Arbitrage trading often feels like it's all about data and quick execution, but some of the most successful trades in history reveal that it's also about timing, psychology, and the courage to make bold moves. From Nathan Rothschild's insights during the Napoleonic Wars to Jim Simons's quantitative breakthroughs in recent decades, legendary trades have reshaped how we think about arbitrage and success. In today's video, we're diving into these historic trades to uncover the strategies and takeaways that can guide modern traders in the ever-evolving financial world. Section 1. Nathan Rothschild and the Battle of Waterloo. Our story begins with Nathan Rothschild, whose role in financing and intelligence gathering during the Napoleonic Wars made him a pioneer of early financial influence. In 1815, at the height of the Battle of Waterloo, Rothschild's agents informed him of Napoleon's defeat well before it became public knowledge. But Rothschild didn't immediately profit. Instead, he executed a clever tactic. He sold British government bonds, creating a perception of British defeat. As panic set in and prices dropped, Rothschild's team quietly repurchased the bonds at low prices. When the official news of victory was announced, bond prices soared, and Rothschild's shrewd moves brought him substantial profits. Rothschild's success was more than just access to information. It was about understanding crowd psychology. By capitalizing on public fear, he created his own arbitrage opportunity. In today's terms, Rothschild's trade is a powerful reminder of how strategic information timing and sentiment analysis can create opportunities. Real-time data still plays a crucial role in markets, but the lesson here is that sometimes understanding how others might react can be just as valuable as the data itself. Section 2. Long-term capital management and the perils of convergence arbitrage. Fast forward to the 1990s, where we meet long-term capital management, LTCM, a hedge fund co-founded by two Nobel laureates. LTCM used convergence arbitrage, a strategy that assumes similar financial assets will move towards similar prices over time. This approach involved identifying minor price discrepancies across global markets, then using high leverage to magnify profits. Initially, the fund generated impressive returns by exploiting small inefficiencies, but LTCM was also heavily exposed to any shifts in these correlations. In 1998, the Russian financial crisis unleashed extreme volatility that LTCM's models couldn't handle. As positions went against them, their excessive leverage compounded losses to the point where LTCM's failure posed a systemic risk. The Federal Reserve intervened, orchestrating a bailout to avoid a financial meltdown. LTCM's downfall is a critical lesson in the risks of overconfidence in models and excessive reliance on leverage. While arbitrage trading often relies on statistical models, traders must remember that these models are based on assumptions. LTCM's fate serves as a warning. Leverage amplifies both gains and losses. For today's traders, managing risk, especially in leveraged positions, is essential, as is the flexibility to adapt strategies when conditions shift unpredictably. The tin crisis of 1985 and over-reliance on market stabilizers. The 1985 tin crisis offers another dramatic case of arbitrage going wrong, this time in commodities. For years, the International Tin Council, ITC, supported tin prices by intervening when necessary, a setup that traders counted on. Arbitrageurs use futures contracts to profit from the assumption that the ITC would keep prices stable. But by 1985, the ITC was financially strained and announced it would no longer uphold tin prices. Without the expected support, tin prices plummeted, leaving traders with heavy losses. This case underscores the risk of relying too heavily on external supports for price stability. Today, similar dynamics exist in markets influenced by government subsidies, central banks, or regulatory bodies. The tin crisis reminds traders to independently assess how sustainable these supports are. Markets can change overnight, and dependency on external stabilizers introduces risk that can turn an assumed safe trade into a costly one. George Soros and the collapse of the British pound. One of the most famous arbitrage trades ever conducted was George Soros's shorting of the British pound in 1992, known as Black Wednesday. At the time, the United Kingdom was part of the European Exchange Rate Mechanism, ERM, which pegged the pound to a narrow range with other European currencies. Soros analyzed the UK's economy and concluded that its fundamentals were not strong enough to sustain the currency peg, especially as other European countries' economies were more robust. Confident in his thesis, Soros started aggressively shorting the pound. As the pressure from his trades mounted, the British government tried to defend the currency by buying up pounds and raising interest rates. But the measures failed to reverse the currency's downward momentum. On September 16, 1992, the UK exited the ERM and the pound dropped sharply. Soros's quantum fund made an estimated $1 billion in profit from this single trade. Soros's bold strategy shows how crucial it is to understand macroeconomic fundamentals in arbitrage. Rather than relying on minor mispricings, Soros focused on a currency misalignment, seeing a massive opportunity where most saw only a high-risk bet. This case teaches that sometimes the biggest profits in arbitrage come from challenging assumptions about what the market will bear, especially when broader economic factors suggest the opposite. Section 5. Jim Simons, Statistical Arbitrage and the Data-Driven Revolution. Jim Simons, a mathematician and founder of Renaissance Technologies, revolutionized arbitrage through statistical analysis. His approach, known as statistical arbitrage, involves using quantitative models to track and predict minor mispricings in assets. The Medallion Fund, his flagship fund, has posted returns so consistently high that it's almost mythical, with annualized returns estimated at over 30%. Unlike most arbitrage trades based on fundamental economic insights, Simons' methods rely purely on data patterns. Simons' strategy is all about timing and volume. He deploys algorithms that can execute thousands of trades in milliseconds, each profiting from minute differences in price. His approach highlights how technology, especially artificial intelligence, can provide an edge by detecting patterns invisible to the human eye. Section 6. Ken Griffin and Citadel's Multi-Market Arbitrage. Ken Griffin, founder of Citadel, embodies the power of diversification in arbitrage. Griffin built Citadel into a trading empire by employing multiple arbitrage strategies across different asset classes. Citadel uses high-speed trading infrastructure and robust data analytics to execute trades in real time across various markets, including convertible bond arbitrage, statistical arbitrage, and equity arbitrage. By having a diverse array of strategies, Citadel reduces its exposure to any single market or model risk. Griffin's success lies not only in Citadel's sophisticated algorithms and data processing, but also in its diversified approach to arbitrage. Instead of relying on a single model, Citadel leverages various strategies and markets, effectively spreading risk and increasing resilience against unexpected market shifts. Section 7. The yen carry trade of the 1990s. In the 1990s, Japan's low interest rates led to the yen carry trade, a prominent arbitrage strategy that involved borrowing yen at Japan's low rates and investing in higher-yielding assets in other countries. This strategy flourished as the yen remained stable for years. But when financial crises hit in the late 1990s, investors faced a sharp appreciation in the yen, leading to significant losses for those who had borrowed in yen. Takeaway: the yen carry trade serves as a cautionary tale about leverage and currency exposure in arbitrage. For today's traders, it's a reminder that even small changes in global economics can impact leveraged trades. This case reinforces the importance of keeping an eye on currency fluctuations and understanding that favorable conditions can quickly reverse. Section 8. The Volkswagen Short Squeeze of 2008. The Volkswagen Short Squeeze of 2008 is a powerful example of how short positions can backfire in arbitrage. In 2008, Porsche revealed it controlled over 74% of Volkswagen shares, triggering a panic among short sellers who had bet against Volkswagen. With the announcement, short sellers scrambled to cover their positions, driving Volkswagen's price sharply up and briefly making it the most valuable company globally. Many short sellers faced massive losses as the share price soared unexpectedly. Takeaway: the Volkswagen case highlights the volatility and risks of shorting, especially when control over shares is in play. For modern arbitrage traders, it's a reminder of the importance of monitoring market-moving news and understanding the risks associated with shorting. Quick changes in share control or unexpected announcements can rapidly shift the market, making it essential to stay updated and manage risk effectively. These legendary trades reveal that while mathematical models and data analysis are essential, true success in arbitrage also requires timing, insight, and risk management. The Rothschilds' intelligent use of crowd psychology, Soros's economic foresight, Simons' quantitative edge, and the cautionary tales of LTCM and the tin crisis all reinforce that adaptability is crucial in arbitrage. In today's markets, traders face new challenges, but the principles remain. By learning from both the triumphs and setbacks of these iconic traders, modern arbitrageurs can develop a more balanced approach, one that combines analytical rigor with respect for the market's unpredictability. So, whether you're inspired by Rothschild's ingenuity or Simons' tech-driven strategies, the heart of successful arbitrage lies in combining data, strategy, and disciplined risk management.